I think my piece here actually follows on quite nicely from the previous speaker. I think a lot of what's been happening in equity markets over the last number of years has been a lot down to central bank intervention and low interest rates. But the thing is, for the last number of years, we've seen a lot of people trying to call a top in equity markets and been rather unsuccessful at that. And as long as we do remain in an low interest rate environment, you could expect to see the same appetite for equities over the coming months. So what I'm going to be looking at is previous bull markets, how long they've lasted, and also what kind of performance we've seen to date over the course of the year in some of the key indices, global indices, and also looking to see what general sectors tend to perform or outperform the broader market in the last quarter of the year. Also looking at some of the event risks that may actually add a little bit of volatility to this market. And bear in mind, volatility has been given something of a bad rap. It's not necessarily a bad thing. If anything, volatility provides you with an opportunity to enter the stock market and buy into shares that may actually be on the cusp of recovering. So that has been something that's been sorely missing for the last while, and it's because of that, the massive trend upwards, the 5.5-year bull trend that we've seen, that it's people have been a little bit disengaged from the equity market space because they feel that it could end very, very quickly. So we'll kick off with this anyway. First of all, I've got to do my risk warning, although this is not about spread betting and CFDs, but everything within this presentation is just my opinion. It's not investment advice and does not indicate any sort of solicitation or transaction in a financial instrument. So we accept no responsibility for any use that we made of these comments. So take everything I say with a pinch of salt, basically, in one fell swoop there. It is actually a 5.5-year bull market that we're in at the moment. And of course, bull markets are normally characterised by optimism, you've got investor confidence, and you've got expectations that the strong results will continue. And then, of course, the definition of it is that it's a rally of at least 20% following a drop of at least 20%. So a really big jump in stock prices following a very scary tumble. And anyone who was involved in the equity market in the space of 2008 would be fairly well versed in what the bounce actually was when we saw it in March 2009. And at the time, we had a huge amount of bearishness in the market, and it felt that it was never going to be coming to an end. Instead, we have managed to grapple back, and we've seen massive increases in equity indices over the last number of years. Now, this bull market is about just over 2,000 days old. So it's been going longer than the likes of the companies like Snapchat and Tinder combined. So we would have to really rally for another 2 years to match the longest bull run ever. Now, I'm not saying that it's going to run for 2 years, but it isn't necessarily the greatest bull market we've ever seen. The record belongs to the 1949 to 56 bull market. That lasted 2,600 odd days, and it drove the S&P 500 about 260% higher. So there could be a lot more gains to be gleaned from this current market. And as long as we stay within this low interest rate environment, and of course we have the possibility that we'll see additional stimulus from the ECB in the coming months in an effort to spur inflation and I suppose growth as well in the Eurozone, that could be very beneficial for some of the broader Eurozone indices. The all-time record then was between December 87 and March 2000, and that lasted 4,000, almost 5,000 days, just over 12 years. So if we are going to see this kind of current bounce in stocks to continue, it wouldn't actually tend to end until 2021, which is obviously quite a period of time away. So as it stands, here is the actual list of the bull market duration. You can see the total months that we have on since March 2009 to last month that I have done this. I've done this up until the beginning of this quarter. So 65 months, 5.4 years, so well below some of the other longer bull markets that we've seen. Now, there is obviously a question as to whether this is based on growth, expectations of growth, or whether it's very much related to the extra liquidity that we've been seeing from the Federal Reserve over the last number of years. This is a chart which you can see quite clearly. It's the S&P 500 and the correlation it has, and I suppose the causation it has when you see quantitative easing take place. So we had the first QE announced back in November 25th, 2008. And then that had to be expanded because the markets continued to decline up until the March 2009. So they expanded that, and we saw a very hefty big bull run up towards, I suppose, the August 2010 when they ended it. And then we had the hints of QE2 from Bernanke, and that provided another put to equity investors to get back into this market and to drive that bit higher. And of course, now we had something of a QE infinity. Now, what is questionable is that back in May of last year, we had what we call the taper tantrum, and where Bernanke actually hinted initially that we were going to see an end to QE eventually. And we did see markets sell off to a small degree. And anyone who was involved in the markets in 2008 would notice that any sort of dips that we've seen in this market have been extremely shallow. And I suppose many of our perspectives are coloured by being involved in the market in 2008. It's very hard to shake that off. There is still a feeling that if QE does come to an end, and it is due to come to an end next month, and we're already seeing the burgeoning yields in the US Treasuries, which are reflective of the expectations that after QE ends, then comes tightening. So whether or not that comes to pass is anybody's guess, but it is keeping the S&P 500 capped around that 2,000 mark, the Dow Jones around the 17,000 mark, and there's been a little bit of reluctance amongst investors to kind of push this market that bit higher because of the level of interest rate risk that could be associated with it. And so far, the ECB have really, they have embarked on additional liquidity measures, but not the full-scale QE that people were really expecting, and what is, I suppose, ultimately needed if there is going to be an increase in credit lending and a little bit more spurring in the inflation levels in the Eurozone. So we wait and see whether Draghi will actually bend to popular appeal and embark on that. And that could happen possibly in the first half of next year. You would expect that with the asset quality reviews on the Eurozone banks in the coming months, that he would be a little bit reticent to embark on something so dramatic until we know exactly how healthy the banking sector is in the Eurozone. And for the most part, let's be honest, it's not all that great. So here's the market valuations across the board up until September 2014, or at least up until Wednesday of this week when I had to produce this PowerPoint. So they're not maybe quite up to date. But you can see there where the valuations are and where the potential opportunities are. So in terms of a book value, you've got the FTSE there at 1.98 times earnings and dividend yield there at 4.92. So fairly hefty dose of yield on the FTSE as it stands. And bear in mind, we're still not through the 1999 all-time high. We have made an inroad at it earlier this month, but due to, I suppose, ramifications in the political space and the Scottish referendum and, I suppose, weaker Chinese data, we have failed to march that bit higher towards 6,900 over the last few days. But if you look at the S&P 500, now that does look a little bit strong. Look at the PE ratio, 19.3, looking probably a little bit overvalued. But if you look at the fundamentals from the US perspective, it does seem to be a little bit stronger in terms of growth. So perhaps that premium is well deserved. And of course, the dividend yield on that is not so bad either. What is one as well, you've got the Euro Stoxx 500 or 600 also looking a little bit on the strong side. So I think if you look overall, you've got the difference there with the S&P, the FTSE 100 and the Hang Seng all looking a little bit like there could be opportunities there in terms of valuation levels. Now, this is not obviously the first and last place you would look when you're making a decision as to where to invest your money, but it is important to be aware of what you can expect in terms of return and what could be interesting to look at. If you look at the CAC, and this is the most interesting thing for me, it's like the French economy has been pretty dire over the last number of months, and it has effectively looks like it is becoming less of a core economy and more of a peripheral one. Yet in all, we have seen a good big move up in the CAC over the last few months, and in terms of PE, little bit overvalued, but you would expect that perhaps maybe the markets are front-running some form of QE from the ECB. So it is something that is definitely there to watch, and if we do see Mario Draghi say that he's going to go and do exactly what needs to be done against Germany's wishes, then that could be an area to look into as well. So, as I said, you often see when you get to round numbers on equity indices, you do see an awful lot of news headlines where it's where there's the top, the bull market's coming to an end, the bears come out in droves because, of course, if the market is going up so strongly, it has to come to an end soon. So here are the months we've had. We haven't seen a 10% pullback on a closing basis. So from October 90 to 97, you had a total of 84 months or 7 years where we didn't see a 10% pullback. Same thing goes between March 03 and October 2007. Again, we had about 4.5 years without a 10% pullback. So all this feeling that a correction is due doesn't necessarily work very well when you look at the historical basis for when and if it might happen. So those who are clamouring for it, and I will admit I have been one of them in the past, but I've since given in to the adage that you should not fight the Fed, and that has worked out fairly admirably. Now that could change, but certainly expecting a 10% pullback just because it's seen as the normal reversion to mean is something that you can probably look back at, as I said, over the course of some of the massive bull markets that we've seen since the 1950s or so, and it show yourself that, you know what, markets don't necessarily have to undergo a 10% correction. You can have shallow ones, 5%, 6%, then it continues higher, and then has another small correction. So it's about finding those opportunities rather than waiting for the full 10% where you will miss an opportunity. And then when it comes to technical analysis, which I'm sure David Jones will be filling you in on quite nicely, probably not 200-day moving averages though, David, no? No. So a basic lesson. You often find that there is a reversion to mean, and generally speaking, when you have equity markets trading above their 200-day moving average, it's generally seen as a fairly bullish bias. But again, you often see that if the market has gone up too far, it will generally come back towards the 200-day moving average, and that can often be a very good place to enter into the markets, particularly on the individual shares basis, but ultimately, I suppose, on the indices themselves, if you are trading them via spread bet or CFD, or indeed via ETF. So since 2014, the 12th of August 2014, we've had 435 days where we have been above the 200-day moving average. So the reversion to mean is not necessarily an indicative measure of whether or not this is a good time to get into the markets. Oftentimes, I think that the scenario at the moment is either you buy the dips or you buy the all-time high. And as I said, that has been working quite well for the last number of years. It's just been quite difficult, I suppose, sometimes for those who were badly burnt in the financial crisis to actually embark and get themselves back into that market once again. So here again are the market valuations on the FTSE 350, and as you'd imagine, healthcare has come fairly well top of the list, and that has been a lot down to M&A activity, the likes of Pfizer, AstraZeneca, and it's the best performance in a sector year to date, up 21, almost 22% year to date. And if you look further down the list, you can see where the areas that are underperforming, and financials is clearly one of those. A mere 0.2% of a rise year to date in that particular sector. And of course, there have been a lot of issues with the financial sector, be it PPI mis-selling, LIBOR, Euribor, whatever it is. There's been a lot of drama surrounding the financial sector, and there's also been a feeling that perhaps the markets and the economy is not quite where it should be. If people are deleveraging, they're not necessarily looking for loans. So while the credit flow might be the issue, if the demand isn't there, then the credit will not actually flow or will not need to flow. And then industrials, clearly the downward effects that we're seeing in the likes of China and sort of weakish, I mean, comparatively weakish growth over there. The fact that we're coming back down from double-digit figures down towards 6.5% has put a bit of a weight on the industrial sector, particularly the mining sector. And of course, given how weighted that is towards, how heavily weighted the FTSE is towards that particular sector, it can obviously be the reason why we're not seeing the same stellar gains within the FTSE as we saw in the likes of the S&P and the Dow Jones over the last 5 years or so. So these are the ones we have to look for. Obviously, it's nice to know that healthcare has done quite well. It's a nice, fairly steady sector. It generally offers a fairly decent dividend yield, and it's not one of those, generally speaking, sectors that elicits like wolf whistles from the trading floor. But it often does give you a good return, a good steady return, without much of the associated volatility you could expect from the likes of the financials and the industrials, and indeed the energy as well. Energy levels, energy sectors is one area as well, massive big market cap and a big driver of the FTSE as well. So if we have got lower commodity prices and oil below $100 per barrel, and you have these Russian sanctions taking hold, that can only be a little bit detrimental for the energy sector. And of course, we have not yet seen the full pain of that. I think come the winter and this quarter, we might actually see the effects of the Russian sanctions and the retaliations on this particular area, and this will provide opportunity whether you want to be long or indeed whether you want to be short, but it will be about picking the right stock at the right time for that. So I think volatility is set to make a return, and not before time, but it will be very important to watch the sectors that are performing well and getting involved in a trend rather than trying to pick an absolute bottom, which is why when you look at the telecommunications services, it's down 17.5% year to date, and then IT, information technology, down almost 8% year to date. So that trend could very well continue. This is the Dow Jones. So it's interesting to note that equally over in the US, the healthcare sector is also the best performing sector year to date, up nearly 15%. And consumer discretionary, it's well ahead of the pack by comparison to, say, the likes of the FTSE. If you go back to the FTSE, we have consumer discretionary just up 0.3%. So this is the one area I would feel that could be due a little bit of a bounce. It's had a very modest increase on the year to date, but if you look at where the consumer discretionary is in the US and imagine where the UK economy is vis-a-vis the US, it does seem to be getting a little bit better. We may not be quite as close to hiking interest rates as the Federal Reserve due to numerous issues, even though I think Mark Carney has hinted just this week that we could see something in spring. But I have tended to take what Mark Carney has been saying with a pinch of salt over the last number of months. The forward guidance from the Bank of England has been confusing at best, and ultimately you generally will not see interest rates rise just before a general election. So this, in some senses, could still help the markets to continue higher in that reach for yield. These are the past observations. I've looked back over several years, about 20 years, to see where the strong sectors were in the fourth quarter of the year. And they were the mobile telecom, which has been underperforming considerably this year. Tobacco companies also doing quite well, and beverages, which I spelt wrong, so apologies for that. So obviously it kind of comes back in a way towards the more safe defensive stocks in the last quarter of the year, and that has been the general theme over the last 20 years. These are the stocks, or sectors, if you will, that outperform the actual broader 350 index. Then you've got your weak sectors, which is your real estate investment trusts, and banks and forestry and paper. So banks have been, as I said, a little bit, they can be a little bit volatile, and especially over the last number of years, they have been removed from the blue chip safe bet to an area that you're not necessarily going to touch with a barge pole, as long as the scandals and the issues in surrounding their balance sheets remain a little bit problematic. So here are the event risks that we have when it comes to the next number of weeks and days. And of course, you've got the Fed minutes coming out next week. Now, Janet Yellen took over the the Federal Reserve as chair, just back earlier this year from Ben Bernanke. And her first speech, she said that as tapering ended, we would more than likely see tightening or interest rate hikes within a matter of 6 to 9 months afterwards. Now she put the cat amongst the pigeons on that one, because we immediately saw a bit of a sell-off in equity markets. So this will be an interesting one to see whether or not there has been a split in the voting system in the Federal Reserve as to whether or not we're going to see even a token hike from the Fed. So that could be an interesting one to note. And looking at where the US is, it's seen unemployment creep down quite considerably. Participation rate is still a little bit of an issue. Last month's numbers were not necessarily as good as what were expected, but that's just 1 month. You also saw GDP growth of around 4% in the last quarter, and it's penciled to be in for around 3.5% in this quarter. So the only thing that's missing is inflation and wage growth, and that is the same thing that is the issue both in the Eurozone and I suppose here in the UK. Certainly from a wage growth perspective, inflation might be a little bit stronger here, but wage growth is not necessarily keeping up. And then moving swiftly on to the end of Fed QE, that is coming. And as I said at the beginning, back in May of 2013, we did see a bit of a sell-off in equity markets as soon as it was mentioned that the liquidity, the punch bowl from the Fed, was about to be taken away. So we're still in a quandary as to whether or not that's going to take place. And at the moment, markets are very much in a holding pattern, waiting new information and new data, and trying to remove some of the uncertainty that we're seeing, which comes down to when the Fed is or is not going to actually act. So it depends on what we're going to see first. I mean, as I said, I was of the opinion up until I suppose maybe a month or two ago that the UK would be the first to hike interest rates, mainly due to the fact that, you know, it was generally quite a broad recovery, not necessarily as balanced as what was promised at the height of the financial crisis, but back to pre-crisis levels, unemployment running quite low, and certainly it does seem, certainly maybe from the microcosm of the city, that the UK is on the front foot. But if you look across the broader parts of the UK, it isn't necessarily filtering its way down there. And of course, as I said, with this Scottish referendum adding a little bit of volatility into the fray, and the fact that we've seen the pound drop by 6% against the US dollar since July 15th does put into perspective how the markets feel whether or not the Bank of England is going to act. And it does seem that for now no pricing in is expected, even with Mark Carney's fabled knowledge that we're going to see it in the spring. So what we may well have is a US interest rate hike, but it will mainly only be a fairly token one and not designed to unhinge the equity markets as they stand. Anytime we do see any sort of pullback in equity markets, you generally speaking see on the wires someone from the Federal Reserve or the ECB or the Bank of England assuaging investors that, you know, nothing's going to happen just yet. There is a feeling out there that while they're independent and while they're generally speaking not supposed to be giving you advice on equity markets, they do seem to want the markets to drive that bit higher. And the idea that the old economic scenario that the actual drip feed effect from the rich will come down to the poor, albeit not necessarily a very successful economic theory. So what we will be seeing, I'd say, over the next number of months will be whether or not, I suppose next week, whether the Scottish referendum passes. So from a UK perspective, that will be very interesting to watch. Now, we saw the banks just this week, RBS, Lloyds, Standard Life, all decide to move their operations south of the border if a yes vote was actually carried. And a lot of the polls have suggested that the yes camp is edging a little bit towards the no camp. But you wonder, you know, what is a poll? Has anyone ever been asked a question in a poll? I have never been approached to do a poll in my life. So I wonder what the actual sample size of the people is, what their political aspersions are and how engaged they are with the whole situation. So I think there could be a little bit of a worrywart around something that isn't necessarily going to come to pass. And because of the fact that we've seen a little bit of a dip in equity markets, albeit we've seen the banks recover a little bit, this could very well provide opportunity. And what is interesting is that while we've seen the pound sink quite considerably against the US dollar, it hasn't all been based around the referendum or anything to do with the UK. It has been very much a dollar bull move across the board. We've seen the biggest move in the US dollar over the last 17 years, and we're reaching heights that we haven't seen on the trade-weighted basis since February of 2013. So a lot of it is to do with dollar strength, and that again indicates that from the market's perspective, the US will be the first ones to jump into the tightening bandwagon, and that will actually be quite decent for UK stocks. We had 137 profit warnings back in July from UK companies, and remember, FTSE 100 companies, they're not a reflection of the UK economy. 70% of them get their actual revenues from abroad, so it's important that the pound is competitive. So the fact that we had these profit warnings as we saw the pound rise towards 170, 172, and the fact that we've dropped back from 6% from there should be actually decent for profitability. So if I hark back to the previous valuations table that we looked at, there may very well be opportunities based on the fact that a weaker pound is going to make a lot of these UK-based companies on the FTSE 100 more competitive and therefore more profitable. So this is something to watch for. I think it's very important to, yes, analyse your individual stocks and sectors, but always have an awareness of where the currencies are, particularly for something like a FTSE 100 stock, and have a very close eye on any news relating to Janet Yellen or to Mark Carney as well. Oh, wrong one, sorry, it's not that computer. So where are the opportunities? Looking back at, here's the interesting one. We pointed out three sectors that actually normally do well in the fourth quarter of the year, and this is the tobacco sector. And you can see that as a chart goes, it is heading towards, and it's hit resistance levels. So, and it's also looking a little bit overbought as well. So this could be an area that might be might deviate from previous quarters, where we might actually see the tobacco sector actually push lower. But there is a nice uptrend there from August of this year, and we could be about to push through that resistance level. And we do like to buy the trend. We like to get on the right side of the trend, and while you might be a little bit cautious about buying near such a resistance level around the 41,000 mark, this could be an opportunity to buy on a breakout as well. So those individual tobacco stocks like Imperial Tobacco, BATS, could all provide a decent uplift in this quarter as well. And here's the banks. I mean, clearly, I have this on a daily chart. Clearly, you can see a downtrend there, but we are seeing a little bit of a bounce since the summer. And what is important to note is that while interest rates might not necessarily suit us, we don't want higher interest rates, really. We don't want inflation, really. But higher interest rates will make the banks more profitable. It will make their net interest margin a little bit more attractive, and that should drive their stock price higher. But while we're in this downtrend on the banking index, you'd be inclined to possibly wait and see what happens with the AQR tests from the Eurozone, because what that might actually do is indicate what other banks are not doing so well, and it will give you a better idea once we get these stress test results as to what banks are actually doing better and what ones to actually avoid. So there is information forthcoming, and that is probably why we're a little bit soft on this particular index, mainly because there are so many unknowns at this moment in time. And then finally, the beverage, which I spelled correctly this time, but I forgot to space. So, you know, slowly but surely we'll get there. This is obviously still an uptrend on a longer term basis since, I suppose, November 2011. And again, it's the defensive area. And this is an interesting one because you have the likes of Diageo, that crowd that do the Iron Brew, which name escapes me right now, they're all, a lot of them based out of London. They could very well start to move operations down south as well, mainly due to the fiscal stability it might be afforded in England rather than this in Scotland. So we are in a short-term downtrend, but we are starting to test the upper band there, which could see us go back up to the highs that we last saw in May of this year. So these, as I said, we've seen the dips, and a lot of the time the dips make people a little bit concerned, but these dips that we can see often provide the best opportunities. So these are the three sectors that generally outperform the broader FTSE 350 in the fourth quarter of the year. Questionable whether or not it'll be the same time this time round, but there are definitely opportunities out there.